Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. Good morning. Welcome to the BOGART Effect. I've got Brian Windsor with me today, and we're going to be talking about one of my favorite topics, which is backdoor Roth conversions. Welcome, Brian.
James, thank you so much for having me back on the pod.
So, in order to talk about backdoor, I think it's important that we need to talk about the different types of accounts. So we've got non-qualified, qualified, and then Roth. Talk to me. What is a non-qualified account?
Non-qualified account, general investment accounts. That's where you are putting your after-tax money that you are depositing into a brokerage account. These days now they're all brokerage accounts. And you don't get any tax savings up front. The monies as they grow, you're taxable at dividends, interest, and if there's capital gains, that's also going to be taxed to you at those different tax rates.
And typically, I find this is the last place we see people actually saving money because you have to first earn it, then you have to live, then you save, right? So, and most of the time we'll see most households saving in their qualified accounts before they save in their non-qualified accounts.
Totally.
So talk to me, what is a qualified account?
So qualified account, think about your IRAs, your 401ks. Sometimes you get some benefits by putting in the money on a tax-deferred basis, meaning you can lower your income. So that money's shielded from the IRS. And benefits as that money grows, it's tax-deferred growth. So in the previous example, interest, dividends, capital gains, they're tax. These qualified accounts stay in the bubble. So they grow tax-deferred, allows those monies to compound even harder for you over the long run.
Which, when you're in a high tax bracket, it makes a lot of sense to put money into a qualified account because, again, you're putting it in at those max possible brackets. And all of that growth is occurring when you're in those max brackets. When you take them out, though, there are some negatives, which is it's ordinary income to take it out. When you reach the magic age of required minimum distributions, which for anybody born 1959 or prior, it's age 73.
They probably don't feel like it's so magical if they're
maybe
these days.
You're getting closer. Then at 1960 or later, it's the RMD age, required minimum distribution age is 75. And the reason this matters is for households, a lot of households, the required amount that they're being forced to take out is more than what they're living on. And ultimately, it's something that needs to be discussed and managed, which frankly is exactly why we come to talk about Roth. So talk to me about what is a Roth account?
So your Roth, you don't get the tax benefit up front, right? So I'm not lowering any part of my income. Now that's the drawback, the immediate drawback up front. But then you get the benefits of the tax-deferred growth. But the kicker tax-free growth. Tax-free growth, I should say. But the kicker in all of that is that when you withdraw those funds, assuming that you've met the 5-year minimum criteria of having it, then all of the contributions and the earnings, again, assuming you're over 59 and a half, is completely tax-free. So all of that growth that you've been able to have over that long period of time, you've already paid Uncle Sam. You've already got into to the party, if you will. So certainly a huge benefit because you don't pay anything on the way out.
So really, at a high level, we're talking about the difference in tax structure, right? And the way that assets can grow in a either taxable, tax-deferred, or tax-free environment, right? With the three different types of accounts. I think a lot of households we work with, they have this misconception, though, that everything needs to be in the Roth. And truthfully, that's hopefully what we're going to be helping remedy for them in terms of the mindset. Because I'm going to come back to that comment a moment ago around in the qualified accounts. If you're in the peak earning environment, let's just say you're in your early 50s and you're making the most you've ever made before, and probably in a position where you can save and actually start really accumulating wealth. Well, the fact of the matter is that that's not an environment that you want to be loading up the Roth. And it's because of this. No, very simplistically, I want to load up my 401k and get all of those tax deductions in the year of contribution, because that is at the highest marginal bracket. Now, when we talk about Roths, the real big negative here with Roths, actually, I wanted to add one positive to the Roth conversation. Roths do not have required minimum distributions.
Oh, that's right. Yeah.
So part of the reason for why everyone thinks they need to have big retirement accounts, think they need everything in the Roth, is because of this conversation around they don't have RMDs. Well, that may or may not be the case. So coming back to the whole discussion of getting money into Roths, one big negative is there's only two ways of getting money into Roths.
Yeah.
Contributions or conversions.
Yep.
And this is a long-winded way of setting the stage for this backdoor conversation. But the thing is to do a contribution, there's an income threshold. And I believe it's $244,000 of income for 2025.
Yeah, that is correct.
And so this is married. But if you make over $244,000, you can't even do a contribution. So the only way to get money into a Roth while you have higher earned income is through conversions.
Or let me just pause real quickly. As we're talking about backdoor Roth, there's also Roth 401ks. And real quickly, if you're listening to this, we're talking a lot about the income limitations for Roth IRAs and those direct contributions. There is no income limitations on 401ks and your income. So no matter what you make, if you have a 401k and there's a Roth source, you can contribute to that up to what the maximum amount is on a year.
So I love that, and I want to pull on that thread a little bit. With regards to contributions into a retirement plan with an employer, whether it's a 401k or a Roth 401k in that plan, you're still capped at the same annualized limit. So it believes $23,500 this year. And if you're under the age of 60, it's an additional $7,500 of catch up. Plus, and then if you're age 60 to 63, it's $11,500, and then you go back to age 64, it's back to $7,500. That's
why are they? They're just saying, hey, if you're 60 to 63, you're cool, you can do more. But as soon as you hit 64,
it's an extra catch up. I don't know. I don't know how they.
Hey, if you're 64 and listening to this, let's figure this out. Email me.
But we're capped at that combined contribution.
Yeah,
and so. Again, I think every person's situation needs to be specifically addressed, because it could be a conversation where we don't want more going into the pre-tax, even though you're in a high income environment, that the Roth might make more sense depending upon long-term projections and how we're building out your plan. But it also could be we don't want to do the Roth because we need to make sure that we're getting more into the pre-tax side, right?
Yeah,
so
I hear you.
It's one or the other.
It's all about having the right plan in place. And that's where, again, I know we're talking a lot about, here's the functionality, here's the reasons, here's the benefits. But at the end of the day, it comes back to having the plan.
100%.
Having somebody that can look at your tax situation today and in the future and run the numbers, run the projections to give you, real-time, accurate advice on what the best way forward is for you and your family.
Bingo. So then let's talk a little bit now about why backdoor and what that means. So we come back to the only way to put money into a Roth is via contribution or conversion. Well, therein lies the opportunity of what is known as the backdoor Roth conversion. So talk to me a little bit about what this is.
Backdoor Roth conversion. Regardless of my income, regardless of income, I can put money into what's called a non-deductible IRA. So I can put, say, the $7,000 into the IRA, a normal traditional IRA, and I'm not deducting it. I'm not going to deduct that off of my taxes. I'm going to let my CPA know that it was a non-deductible contribution.
And they'll fill out what's called an 8606.
Make sure that is filled out, by the way, and that you hold on to that.
Think of that as the cost basis of the IRA,
like the
after-tax amounts that go into those accounts.
So now I have this pot of money. Let's just say, again, it's $7,000, and because of my income, I can't deduct it, and I couldn't go to a Roth. But now I have $7,000 of after-tax contributions in this non-deductible IRA. There's no earnings, there's no gains. I haven't invested it. So what I'm then doing is then converting that $7,000 of after-tax money, and that is now going into a Roth IRA.
And because it was after-tax dollars that you didn't take a deduction on, it's completely tax-free on this conversion. So I sometimes affectionately call it a pit stop in the IRA. You have to do a little bit of extra tax coding to declare the non-deductible contribution into the IRA. but we're moving money from non-qualified after-tax funds via the IRA into the Roth. So now it's growing tax-free forever. And this is a strategy where I think it's an absolute no-brainer, assuming you have the discretionary savings capabilities and can leave the money alone, right?
Yeah.
It's time value of money. The sooner you can get these things into these vehicles and then let them growing and compounding, like that's where the magic is.
Totally.
And why these things can be highly accretive. The challenge, of course, is, every dollar is chipping away at we've got kids to pay for, you've got, grandkids to pay for, you've got, expenses associated with living, right? This is where we want to be able to leave it, set it up, let it go, and leave it be.
Yeah.
If you can tell, I do love backdoors, and I think it's one of the best ways of accumulating, especially for individuals who are in those later earning years where all of a sudden they now have the ability to have discretionary savings. One comment I wanted to make was, in order for this to work, you can't have an outside IRA account with any pre-tax monies in it.
Yeah.
The reason is I want to use your 7,000, but let's assume that you've got 21,000 of pre-tax money in. Now we add this 7,000 in, so now the balance goes up to 28. When we go to do that conversion of the $7,000, even if we only do the $7,000, that means that only 25% of it, so 7 divided by 28, is actually tax-free. The other 75% of the $7,000 conversion is now taxable.
Yeah.
And so this is another fantastic example of where planning becomes so impactful and being able to have full visibility. And by the way, that's IRAs outside of a 401k. So if all the money is in a 401k, it does not matter. That pro rata rule,
403B or TSP, all of that.
Any employer-related retirement accounts. So I've had situations where it's actually made sense because someone's young enough that we actually move a pre-tax IRA back into a 401k because now we open up the capability to be able to do this. I've also had situations where, I'll use my wife and I. Mm-hmm. Before we got married, we were in slightly different tax brackets. Before we got married, it made sense to go ahead and convert her. We had rolled a 401k out into an IRA, but a relatively smaller amount, but go ahead and convert the entire IRA, over into a Roth.
Yeah.
So now we had the capability of doing this backdoor strategy year after year after year.
Totally.
And again, it was because she had pre-tax money sitting in an IRA account that would preclude us from being able to get these monies converted on a tax-free basis. All right, so just a little side note on that.
Yeah, and again, that also is across institutions as well. I don't know if you mentioned it, but sometimes clients I hear, well, what if I open up this $7,000 IRA with you guys, but then I got my old IRA at my old company or the other firm? It don't work like that.
No,
it's across all accounts, all platforms, an IRA asset. So that's why what James is mentioning is if you do want to effectively have a non-taxable backdoor Roth conversion, all of the pre-tax monies, regardless, have to go back into a 401.
And I have seen this bite people years later, right? Like it's not one where the IRS is going to notice it that year. It's like 3 or 4 years later. It's like, oh, 2022, oh, great. And then we've got to do a recharacterization and recode. It's
totally
one where just understand the rules before you're making the decision.
I think that a quick plug for fiduciaries across the board, whether Bogart Wealth or other fiduciary financial firms that are out there, is that if you are working with a lot of brokerage firms, those sorts of places, a lot of times they're, call it incentivized because they're looking to try to get monies in the IRAs. That's how they get, some compensation on that. The nice thing here about us being fiduciaries is that I'm going to give advice to a client to say, it makes more sense for this IRA to go back into your workplace plan.
Yep.
Because of the type of tax planning that we're able to do. So just making sure that you're working with the right people that not only can see the bigger picture in all of this, but also that have your interest at heart.
Well, and I would tell you an effective financial advisor, and I've said this on other podcasts, they're able to anticipate your problems.
Yeah.
Right. And really what we do is solving people's problems. And I would tell you a lot of the households we work with, it's around tax. It's not just the investments, right? And so, a good financial advisor is able to put themselves in a position to anticipate what those problems are going to be. The example you just gave is exactly that, right? Where we're looking at the present. We might not have a problem right now, but fast forward 5 years, 10 years, 15 years, 20 years, we might have a very meaningful problem that needs to be addressed. And a lot of wealth creation isn't just how much you save. Yes, that's a big part of it, but it's how much time you give it, but it's also where you save it, right? So the reason we began this podcast with framing with the different types of buckets is to recognize there's value in having monies accumulated in each type of bucket, not just all in non-qualified or all in qualified or all in Roth. And so understanding the nuances and ways of being able to not only accumulate wealth, but in the most tax efficient manner is highly, highly, highly valuable. Now, real quick, I wanted to kind of put the plug in here. If you're in the position now to be able to save monies for your children or your grandchildren, if they have earned income, this Roth accumulation strategy is unquestionably the best way of doing it. And it might not be they need to do a backdoor because they're below the income thresholds, but if they're over the income thresholds, the backdoor makes perfect sense. And a lot of people just don't understand that they can do this, where they can put money into an IRA and convert it over to Roth, and now it's growing completely tax-free.
Oh, yeah. I see that a lot with clients, too. When you're looking at, multi-generational planning, James, and you're looking both, and you're working with the parents, and they're having their own tax situation, and you're working with them. But a lot of times I'm asking to meet the kids and work with them, and a lot of times it's really out of making sure that everyone understands their place in the financial plan, and understanding that we can help our kids save in a more effective manner, right? You don't need to know everything about your kid's situation. They don't want to know everything about your situation either. But there's an easy conversation to hey, I want to introduce my advisor to you. Let's just have a few minute conversation about their specific situation. And a lot of times this is where we're bringing those up.
Well, and especially if we're in a position where there's going to be a wealth transfer, legacy discussion, doing some of these things now in their name versus mom and dad accumulating it in their own names, it's actually way more beneficial to get it over the kids.
I mean, think about it. Let's just say I'm going to put that $7,000. Let's use that example. And I'm going to put it in an XYZ investment, dividends, interest, capital gains. That's a drag on my taxes. I am paying a fee to the IRS every single year to have those assets, when, in fact, if that money's going to the kids anyway, I can have that go to them right now, and they get tax-free growth. They get complete tax-free withdrawals. Just a huge way of helping to save money.
I mean, Roths are fantastic. So we talked a little bit about the mechanics of it.
Yeah.
What would be an appropriate investment strategy of these Roths?
Oh, yeah.
I mean, and so I'm a little biased here.
I know. I'm waiting to hear. I want to know your opinion. I want to hear this.
Well, to me, I think of an investment thesis where we have our buckets, and this is absolutely where everybody is going to be completely different. When I compare, let's just say a 30-something-year-old investor versus a 70-something-year-old investor.
Thanks for saying I'm a 30-year-old investor.
I mean, I'm speaking for myself. I got a couple more months. But the point is like you have a longer time horizon per se than a 70-year-old, right? So may or may not exist, or even think of kids, right? Like if you're 21-year-old coming out of college, I'm doing a lot of mentoring right now, and it's like you're 23, you have the unlimited time horizon, not quite unlimited, right? But you've got a long time horizon. Let's take risk. So when I think about the buckets, and I come back to the non-qualified, the qualified, and the Roth, non-qualified for most retirees as they transition out of the workforce, that's usually where cash flows are coming from. And that's going to most likely be the first place that we're drawing on for cash flow purposes. Then the qualified, which is the IRAs. Last is the Roth. And so by definition, that Roth is most likely 10-year and beyond money. So when I think about building an asset allocation for a household, and I'm not going to say a 30-year-old and a 70-year-old are the same, but we do need to look at it at a macro perspective, because time horizon north of 10 years presumably is where we should be taking risk that's commensurate with your respective risk profile. So like I think of me, and my risk profile is pretty aggressive. Where I'm taking almost all of the risk that I can tolerate is in those retirement types of accounts. Not to mention I can't touch it till 59 and a half anyway, so got at least a 20-year time horizon, plus. So the idea there being is that's where all the risk should be. But it's really in that same conversation, if we're in a position where we're not touching Roth money for north of 10 years, or we're leaving money to kids, which is what we're projected to be, that Roth bucket to me is actually still where we should be taking risk. Now, that 70-year-old might not have the same risk tolerance. So instead of it being 100% equity allocation, it might be a 70-30, an 80-20, whatever's appropriate for them. We have plenty of clients that you and I are working with together. I have one in particular I'm thinking of where we've had to kind of have that conversation around risk. And it's like, we need to be mindful of, it's not just, we don't need all of these monies right now today, right? And so we should be taking on a respective amount of risk associated with it.
Because you got to think about, if it is going to the kids, right? And I think we're get into this now, is to talk a little bit about when your kids are receiving these monies, right? So we talked about the differences between non-qualified, qualified, and Roth. Non-qualified, your kids are going to get a stepped up in basis. They get immediate access to the funds with that, tax implications start right away, but they get the step up in cost basis. Qualified assets with the Secure Act, they have to take that money out within a 10-year time period. So if that's where all my wealth is, and we're talking a large sum of money, 7 figures.
I want to slow that down just to quantify this a little bit more. So let's say, for example, you've got 2 children, and let's say all of your wealth, make up the number, $3 million, is sitting in an IRA account when you die. Well, that means that most likely, if it's going to get split 50-50, each of the kids get $1.5 million. Yeah. They have 10 years to withdraw that full $1.5 million from an IRA account. So just evenly disperse it, right? Assume it's $150,000 a year, 10 years, 1.5 divided by 10. That means that they each have $150,000 a year of income, right? The reason this is important is because they're probably inheriting that money in their peak earning years.
Totally.
Right?
Yeah.
So they're
40, 50, 60 years old.
They're probably in their 40s to 60s. And that might have a material impact on them. Sorry, I just wanted to place more emphasis
because what you're talking about is a difference of, let's just say, even if I'm the retiree and my tax bracket is, say I'm in the 22% tax bracket with my required minimum distributions, maybe even the 24%. Now, all of a sudden, if I pass away, those monies are now going to be in a 35, if not 37% tax bracket, because that's what my kids' tax rates are going to be. So the big difference in doing Roth and backdoor Roth specifically is that, kids are going to get it. They have a 10-year window. However, that's non-taxable to them. So effectively speaking,
you said, sorry, the Roth is non-taxable.
The Roth, yes.
Just wanted to clarify that point.
Thank you. I appreciate that. So that you have a better way of giving, the sweat equity, the hard-earned money that you've developed over a long period of time. You are now bequeathing more of that to your kids because effectively less is going out the door.
So another way I frame this a lot of times when we're presenting it is, not only do the Roths carry no required minimum distributions for you, which is really ultimately why we're doing this recommendation of Roth conversions, right? The longer you live, it ultimately frames it where you're better off doing these conversions and moving more monies into a Roth. But the fact is if you're in a legacy situation, whatever's left over, factor in another 10 years of tax-free growth, and it's phenomenal. But coming back to the backdoor, right? Because we've kind of talked a lot at a macro level about Roth. Backdoors, I think it's an understated but really, really impactful way of accumulating wealth, because really what we're talking about is $7,000 to $8,000 a year, which in the grand scheme, some people would say, why do you care? Well, frankly, when you start looking at time value of money and letting these things accumulate, it starts to become very real money. And whether it's a direct contribution into a Roth or using the conduit of a backdoor to get it into a Roth, you look at starting saving at the age of 21, by the time someone's 60, using an 8% growth rate, it's about $1.6 million, right? So you think about that. That's roughly 40 years of contributions at $7,000 a year, right? So $280,000 at a gross level. But because of investment and growth, that becomes $1.6 million. Just by waiting 10 years and going to age 31, all of a sudden now it drops down to $960,000, right? So a very significant drop with just doing 10 years less of contributions. So the earlier we can get these monies into these types of accounts, the better off we are, which is why when we talk about legacy, we talk about helping your kids, we talk about ways that we can add value to their lives. This is the conversation that we really need to be having.
I think it's take every inch that you get. I mean,
Absolutely.
don't leave any stone unturned when it comes to this, because I mean, there's nothing more critical to your long-term success than working with what you can work with. I mean, it's just.
And while we're talking about this, let's talk a little bit about mega backdoor Roth, because I think a lot of people ask this question and it gets sensationalized.
Yeah.
We do a lot of content on mega backdoor Roth. But conceptually, to me, a mega backdoor Roth is essentially the same thing we're talking about with a backdoor. It's just instead of using an IRA account, we're now using your 401k.
It's exactly the same.
Right? So just to kind of frame this out, right, you have the ability to put after-tax contributions into a 401k plan.
You may have the ability of putting it in there. Every 401k is different. You got to check with your plan provider to see if they allow it.
But if you do have the ability to put, thank you for clarifying, the ability to put after-tax dollars into a 401k, you can then use the 401k as the conduit to do what's called a tax-paid withdrawal and get those funds, the after-tax portion of those funds, plus whatever respective gains in there, moved to a respective IRA and Roth IRA. So now they're growing tax-free forever.
As opposed to, let's just say you make the after-tax contribution in your 401k and you don't do anything. I see that a lot. And what happens is, let's just say you have that opportunity. I'm already maxing out my 401k. I want to put a little bit more in. They're going to allow me to do it. I'm going to set it up and forget it. Okay, excellent that you're saving a little bit more, but here's the issue. Issue is that money grows tax deferred. So as that money's growing tax deferred, that money is going to be subject to taxes at some point in the future, whether it's when you do withdrawals or when you have those mandatory required distributions. So what we're talking about here is, okay, well, let's just do it as the pit stop and then get the ability of moving that money over to a Roth, which would be a taxable event.
Another fantastic example of why someone needs to have a financial plan in place. And looking at this at a macro level, because again, it's not just the today, it's also the future.
Yeah.
Because by the way, if we don't have a required minimum distribution issue, we don't really care, right? Like at the end of the day, it becomes a marginalized thing. Because, and the reason I'm saying it that way is because when we talk about the after-tax monies that are accumulating in a 401k, you have the ability to use it to offset the cost basis of NUA stock, for example.
Yeah.
So theoretically, if we did the mega backdoor, we're reducing the amount of NUA stock, right?
If you have access to NUA within your 401k plan. Again, why you need a plan, everyone's going to be different here.
But then also you can have it go directly to a Roth or you can pull it out. The problem with the latter two is what you just identified, though, is if it's in there, all the growth is happening on a pre-tax basis.
Yeah. I mean, there's, again, not the end of the world, but I certainly think there's a better way of doing it.
This is, when we've plugged this a couple times, but this is why annualized planning is so important. And I understand for any individual that's in their earning years, you got a lot of things that are distracting you. Needing to come back and just, even if it's a very brief 20 to 30 minute temperature check, like how are we doing? What
has to happen.
I mean, and I can't tell you, like most of my peers, they don't have financial plans. It baffles me, right? Like,
I have my best friend who is he's in medicine in Louisiana. I'll just leave it at that. And I talked to him about doing the backdoor, and so he was doing it and thought he was so smart about it. And the one quick thing that he didn't realize is that he had to invest the money as well.
Oh.
So I think 4 years went by when I asked, hey, how's that doing? He's like, yeah, it's good, but I'm not earning anything. So quick plug, making sure that you actually still invest your money.
Well, yeah. Put the contribution in, but then also get it invested. Smart for growth. But no, I agree with you. It's having that plan in place. Again, we're pushed and pulled so many different ways. You and I both have 3 children. I mean, every day is it's wild. I mean, as a lot of parents are listening to this, they get it. They understand what we all go through. But if you're not looking at this or having someone else or to look at this for you, effectively speaking, no, at the end of the day, you may be leaving money on the table. And over time, as you talk about the compounding, you're leaving a lot of money on the table. So it absolutely pays you to work with an advisor. Take that 20 to 30 minute temperature check every year about where you stand. At a minimum.
To get advice on these types of things.
Yeah. And if you're not going to be deliberate about your finances, who else will, right? And this is one where I believe in advocacy, having somebody that's working on your behalf, it's imperative.
Yeah.
Brian, this is fantastic. Thanks for the time this morning. Looking forward to the next one.
James, thank you for having me on the pod.
Thank you.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.